Hey guys, what's going on? In this video, we're going to talk about short and long-term capital gains tax since this is December and people will have a lot of questions about it since it's the end of the year. So, if you don't know who I am, my name is James Mason. I am a successful stock trader. I actually offer a free 8-hour course in stock trading, and I will soon be releasing, just kind of a mini series with how I trade options. So, for that free stock trading course, just go up to my playlist. I actually teach it in 2 different styles. Playlist number 1 is using EMA lines. Playlist number 2 is using Bollinger Band lines. So let's get into this. Short-term capital gains tax basically is when, since we're talking about stocks, we're just going to keep it, with stocks, is when you hold a position in a stock 1 year or less. Long term is obviously over 1 year. So, with a lot of traders in OTC, and especially new traders, they get so caught up in their trade with this whole fear of capital gains tax. The truth is, and this isn't being mean, this is just being truthful, the truth is 95% of traders will never experience short-term capital gains tax. 90% of traders statistically lose their money anyways. That additional 5% I just threw in there, in order to meet the requirement for short-term capital gains tax, you have to go beyond so many tax brackets. And basically, you just have to make a lot of money, and that amount will vary just depending on, married, single, where you live, just things like that. So, with short-term capital gains tax, again, it's an investment held less than a year, and if you sell it before that year, it is treated just like normal income for you. So whatever you end up getting taxed on just depends on what tax bracket you fall in. Now, long-term capital gains tax, if you hold it 1 year, 1 day, or longer, it's either going to be 0%, 15%, or 20%, and it really just depends on the asset that you are holding, and just other variables, and that's really something that you need to talk to a CPA about to get a specific answer that will pertain to you. So, OTC traders and new traders, just focus on your trade. That's what you need to do, is just focus on your trade. Short-term capital gains tax is really not that bad, if you can even hit it. And like I said, that's not being rude. I'm not talking down to anybody, but it's just how this game works out in the world. So a lot of traders get so caught up on trying to dodge this short-term capital gains tax that the taxes that they would have paid if they would have met the requirement for that short-term capital gains would have been a lot less than holding a penny stock that had actually tanked. And so therefore, they could still, be in a profit, at the end of that year. But we'll just, I just have this ticker up right here. I'll just break it down since numbers are a lot simpler than just trying to explain something hypothetical without something visual to represent it. So let's just say someone gets in right here at 0.0005, and then it spikes up here to 0.0085 for the high for the year. This is a 1 year, 1 day chart. So this is the high for this year. Well, then it tanks down here, and you have a lot of traders who are just so fearful of locking in the profits, let's just say right here, because they want to avoid this big bad number that truthfully they don't even know about, called short-term capital gains tax. And so instead of taking that profit anywhere in here, or even here, they'll hold this thing. And the stock will just keep on bleeding and bleeding and bleeding and bleeding until either they decide to take a very tiny profit, or then they end up actually losing money, which makes no sense at all. So instead of, locking in your profits at, let me get right here to 0.005. Instead of locking in those profits, let's just say, well, hold on, I need to change this. So, come on, here we go. Instead of locking in your profits, let's just say they got in right there and missed this spike. Right there would have been a percentage gain of over 1,500%. And then it tanks, and even down right here, this is still 551%. Just lock it in. Lock it in, walk away with 551%, and it's still a good trade. Because your capital gains tax is not going to be so much that you're going to regret it when, let me lock this in again right here at 0.005, when you could have took it right there at that trade, but instead you just decide to take it over here. Let's just say you decide to sell before your year anyways at 76%. Now 76% is still great money. Not necessarily a great trade here, but it's still a great profit. But when you passed up all of the other hundreds and thousands of percent that you could have had just to avoid some short-term capital gains tax, it just really doesn't make sense. So focus on your trade, and then the money will come. Don't worry about the tax, ramifications of, am I gonna have to pay too much tax this year? Well, if you made a lot of money, who cares? Just don't blow your money before you have to pay taxes. That comes down to, accountability and discipline. Take your profits when you have them. Don't skip over profits just to avoid some small percentage of paying taxes. When really the difference, between your normal tax bracket and like a true short-term capital gains will probably only be 5, maybe 10%. And in the realm of things, that's not that much. So I hope this video opens someone's eyes, because I see so many traders in these penny stocks who are passing up these spikes because they're just trying to avoid this short-term capital gains tax, and it's because they honestly don't understand it. And they're letting however much slide away. So, I appreciate you guys taking the time to watch this video. If you haven't yet, please subscribe, and let other people know who are trying to learn how to trade stocks about my free stock trading course. I also have a Facebook group called Transparent Traders. If you check it out, you can also check us out on Twitter as well. We go by Transparent Traders there also. So again, thank you for watching this video, and we will see you in the next one.